Hope you guys had an awesome Christmas eating whatever you guys eat, whether it's roast beef or turkey or both of them. I, for one, did have an amazing Christmas spent with my family. We got together, had some turkey, roast beef, and duck as well. So it was pretty delicious, and now we're getting back into the swing of things with the new year coming around. I have one major announcement today, which I'll be talking about before I get into today's content, and that announcement is that I just created my Patreon page. And for those of you who sign up for my email list, you'll have gotten that email. Maybe it's in your junk, but now that you're hearing from me, you can go ahead and check that out. I have a link in the description down below. Some of the rewards that you can expect to receive if you are a Patreon member is stock buy and sell alerts to both my Wealthsimple portfolio and Questrade portfolio, depending on what tier you're in. You'll also get access to my video scripts or just notes, so you can read those if you don't have time to watch the video. And another thing you could receive is if you're in the top tier, you can have a 45-minute chat with me every single month, and we can just talk about anything from life to stocks. For now, there's a limited number of spots in the top tier Patreons, which includes the buy and sell alerts for my Wealthsimple Trade portfolio, as well as my Questrade portfolio. So if you're interested in that, check out that link down below in the description, as well as the pinned comment. Anyways, on to today's video, which is 5 stocks to invest with $6,000 in your TFSA when the limit refreshes on January 1st, 2021. Before I get into this video, if you wouldn't mind, please smash that thumbs up button, as it really helps me as a creator to continue to provide you guys free content on my thoughts about Canadian stocks out there. The first stock on this list is OpenText. And the reason why I chose OpenText is because the stock looks fairly undervalued when comparing it to its other peers in the software space. And what OpenText does is that they're an enterprise information management solution that helps empower the biggest brands to drive sustainable growth and productivity. And honestly, OpenText is quite a broad business. They have a lot of different solutions for a lot of different business problems. And I think that's what makes it not as appealing to retail investors, because it's a lot harder to understand as a whole. And I think that the style of management doesn't exactly suit the retail investor right now, where retail investors are looking for hyper-growth stocks that have 50% year-over-year revenue growth rates, which this company does not have. However, what OpenText does have is a steady revenue growth of around 10 to 15%, and they have positive earnings, which is eventually what a lot of these tech companies with 50% growth want to get to. And by the time they get to that, their revenues probably won't be growing at 50% year-over-year. Right now, OpenText sports a P/E ratio of around 47. They also have a dividend payout, which is another way that they're paying back their shareholders. And on top of that, they announced a share buyback. And why did they announce a share buyback? It's because management believes their stock is cheap. It's down around 7.35% from its all-time highs back in February 2020. And I think I agree with that stock repurchasing program. If we look at a lot of other software stocks that are out there, their stocks have grown anywhere from 50 to 100%, and some even like 300 to 400% since the whole pandemic hit, which is absolutely crazy when the revenues probably have only grown by anywhere from 50 to maybe 70%. I think that for OpenText right now, the fact that the stock is still down 7.35% and revenues are actually growing faster in the past 3 quarters versus in 2019, this stock signals to me that it's relatively undervalued. They have gross margins of 75%, which is very typical of a software company. They grew their revenues by 15.4% to $804 million in the quarter. This puts them today at a PS ratio of around 3.9 when their market cap sits at around $12.4 billion. Their cloud services revenue, which is their fastest growing segment, grew by 43.7%. And for those of you guys who know anything about software, cloud is where it's all at. So it's good to see that OpenText's cloud business is growing faster than its total revenues. Their annual recurring revenue is by far the largest portion of the revenue, sitting around 83% of that $804 million. And that grew about 22% year over year, which is also faster than its overall revenue growth. Right now, they paid a dividend of 1.76%, which is great for anyone who's also looking for some small income on the side, while seeing the stock hopefully appreciate over time when investors catch up to the news that OpenText is not a dinosaur company. In fact, they're still growing at fairly healthy rates, and I think that they have a very sustainable business going forwards and will continue growing this business through mergers and acquisitions. The second stock on this list here is Enghouse, and this is another stock similar to OpenText. Enghouse is another software business out there in Canada that's a little bit tricky to understand. They do quite a few things within their space, and I think that maybe this is causing confusion for a lot of investors. They have two main business segments called the IMG and AMG spaces. Their IMG, or Interactive Management Group business, focuses on customer interaction software and services which are designed to facilitate remote work, enhance customer service, increase efficiency, and manage customer communications. Their AMG, or Asset Management Group, has a number of software and service solutions for verticals such as cable operators, network, telecom providers, media, transit, defense, and public safety companies. And I think that right now this business probably got hit a little bit. The fact that their second asset group, the AMG business group, focuses on a lot of companies that are starting to become a bit more like dinosaur companies. The media space, like television companies, are becoming a thing of the past, whereas things like Netflix or Disney Plus are coming in and sweeping away the consumers. Cable operators, they're going to also be a thing of the past, so this is going to be a vertical that's going to be dead in the future, I think. For these reasons, I think that Enghouse stock actually got hit quite hard. They're down from the all-time highs of $80 per share, down to about $61 per share today. The fact that Enghouse has been around for quite a while and has learned to adopt to the changing landscape of how business is done, I have no doubt that this business will continue to pivot and migrate towards the newer age businesses out there. They've already showed this with their IMG business, which focuses on people who are doing remote work, which is ultimately where the world is headed towards right now. We see big companies like Facebook or Shopify where they're having a lot of employees permanently work from home. The business is also not very flashy. If you go to the website, it's honestly not the greatest website out there, and it could do with some revamping. And I think this is one of the reasons why retail investors might avoid this stock right now. But if we dig deeper into the business and look at their financials, they're a pretty solid company with revenues growing around 30.9% in this year when the whole pandemic hit. They also have no debt on their balance sheet and a healthy number of current assets to continue running the business going forwards. On top of that, management just announced a special dividend of $1.50 per share, which is quite large for any shareholder out there right now. With a share price around $60 per share, I think this is roughly around a maybe 4% dividend or so. But this company, on top of the special dividend, does pay a quarterly dividend. So this company is a cash generating machine for anyone who's investing in it right now. In the past year, the company generated around $500 million in revenue, and their market cap sits around $3.4 billion. So the PS ratio is around 7, which is not too high compared to some of the companies out there in a similar space providing software systems. I think that this company will continue to provide shareholders with dividend growth as well as stock price appreciation going forward. And the fact that this company is down around 25% from its all-time highs, this might be a great time for investors to get in with their TFSA and build out a position in Enghouse for future growth ahead. My personal price target to buy into Enghouse right now is that if the stock price comes down to $55, because this is its previous all-time highs. So I think that this is a pretty good support level, and we may see the stock drop to there because right now, if you're looking at the charts, it's on a downwards trend without any sort of sight of a rebound. So I think that $55 is probably the next place where we'll see some sort of consolidation, and that's where I'll be looking to pick up some shares of Enghouse. The third stock I have for you guys today is Shopify. And for those of you who follow my channel from the early days, I did quite a bit of analysis on Shopify, so I know a good amount of detail into different verticals that they're pivoting into. Things like they are creating a bank account for their merchants. They also have Shopify Fulfillments, which is going to be a game changer for them, as well as they have things like Shopify Capital, which is giving out loans to businesses so that they can have cash in advance to purchase products and eventually pay that back with some interest. I think that Shopify Fulfillment is actually going to be a huge growth vector for Shopify, bringing a lot more merchants onto the platform going forwards. Right now, I myself run a Shopify store, and I know the pains of a small and medium business. Shipping is the one biggest pain. So right now, shipping through Canada Post, you're still paying fairly heavy rates. Like for my package, I pay about $14 to $15 per package. I think that for Shopify, they're going to be able to undercut what the post office is charging for packages and also have a faster delivery time as well. Canada Post delivery time is around 2 to 5 days for the cheapest service of $15. If I want a priority service, which is 2-day delivery, which Amazon offers, it's going to cost me about $30. So I think that Shopify could offer this competitive service, probably of a 2-day delivery service just like Amazon, and this will attract a wider audience of small and medium businesses who are struggling with shipping and logistics. I think the reason behind Shopify and opening up a store is that you can brand your store. On Amazon, you're kind of like any other fish in the sea. Your product's on a white background and they all honestly look the same. But if you're able to build up a brand like on a website and show your customers what you're all about, your different services that you offer, as well as some nice product photos, this will sell a lot better than a photo of your product on a white background. And Shopify is also building out an app called the Shop app, which brings all their merchants onto one platform. On the Shop app, you can view your favorite brands as well as discover new stores and just see that store in their whole brand image instead of just their product on a white background. And I think that customers today are looking for a brand to connect with, and they don't care as much about, the nitty-gritties of the product, whether the plastic is made of ABS or like 3D printed stuff. They care more about what the company stands for and the warranty and the policies behind it and just the whole story behind the company. And this is what Shopify allows merchants to do, is to tell their story and build up their brand and also build up more rapport with their customers through interactions on email. If you look at Shopify's previous quarter, they grew their business by 96%, which is crazy for a beast like Shopify. Shopify's market cap is over $100 billion, probably around $150 to $170 billion today. And the fact that they're growing their business at almost 100% year over year is unheard of. Their subscription revenue is growing by about 58% year over year, all the way up to $254.3 million. And this growth is not as impressive as their overall revenue growth. But the main driver of the revenue growth is a general merchandise volume, which is ultimately the fact that their merchants are selling a lot more through Shopify's platform, and Shopify is taking a cut of that for themselves. And some people might look at this as a negative point for Shopify because after the whole pandemic's over, people will go back out and shop in stores instead of shopping online. But I think that with their fulfillment network coming online and shipping times being a lot more competitive for their merchants, we could probably see that the growth of their merchants online won't slow down. I think that this whole fulfillment network is really going to be a huge thing for Shopify going forward. So watch out for more news on that. The last two stocks I have for you guys today are Descartes and Kinaxis. And these two stocks are both playing in the supply chain management space. You might think they are competitors, however, they're not exactly competitors and they might actually be complementary businesses. I read that Kinaxis helps with those companies involved in international trade, where they're shipping over products in shipping containers from overseas to here in Canada or North America or in Europe. Whereas Descartes is handling more of the last mile delivery, where their system plugs into logistic management companies and helps them manage that last mile delivery. So any sort of company out there who sells physical goods could possibly be using both these systems. If we compare the two businesses though, Descartes is a bit more mature with a larger market cap, but is a slower growing business. Kinaxis has a smaller market cap and their revenues are growing faster than Descartes. Both these companies don't pay a dividend, and they both also saw positive growth in 2020 despite the whole pandemic happening, which is a good sign. If we look at the stock price for both these companies, Descartes is down around 7.35% from its all-time highs, around $80 per share, versus Kinaxis, which is down around 20% from its all-time highs of $225 per share, down to $180 per share today. I think that both these companies could be a good play for 2021. Looking at Descartes and their stock chart, their stock has been trading fairly range-bound, which presents some opportunity where investors are looking at this right now, and the company hasn't really grown much in stock price appreciation. And if they do perform well in the coming quarters, we will see the stock move up in step. And I think that the fact that e-commerce has great tailwinds ahead of it, where people are more inclined to shop online, Descartes software is going to become a necessity for a lot more businesses out there, and we should see a nice uptick in the revenue for the years going forwards. As for Kinaxis, this business was hit quite hard in the previous earnings, where management was saying that the company had a few customers not renew their subscriptions. And this sent the alarm bells going off in some investors' minds, the fact that companies aren't re-signing with Kinaxis, showing a weakness in their business. However, Kinaxis also has a large pipeline of customers still that they haven't gone through, and usually their sales cycles are anywhere from 9 to 18 months or so. So despite some customers not re-signing with them, which is totally understandable because a lot of these physical good customers right now are getting hurt by the pandemic and all the lockdowns. However, Kinaxis is still thriving, I think, with a bunch of the other customers that they're bringing on, which are more e-commerce focused. Kinaxis is solving a major supply chain problem for the customers, which is being able to respond to an instant shift in supply and demand. Essentially what the product does is inform management and those decision makers in the company when there's an imbalance in supply and demand. So for example, if a supplier all of a sudden says they can't make this order, Kinaxis' management all over the place will be informed of this problem there. Traditionally, it would take managers a lot more time to figure out there's maybe a spike in demand here or a shortage in supply here because they would be going through spreadsheets of data and maybe they miss a few things. Kinaxis' rapid response platform is going to use artificial intelligence as well as machine learning to inform management right away or even predict if there's a supply constraint or if there's a spike in demand from a certain product out there. So this is the value that they provide businesses, is an on-time response to a spike in demand or a shortage in supply, and management can adjust accordingly right away. Versus if they were to wait a couple of days, they could be losing out on millions of dollars or spending in excess of $1 million on buying products that people don't actually need. Are any of these 5 stocks that I listed today on your buy list for 2021? Let me know in the comments down below. For me personally, I will be looking into Enghouse as well as Shopify, and the other 3 I'll be keeping on my radar if I want to add positions in those for my Wealthsimple portfolio. If you guys have any questions or comments, leave them down below. If you like this video, smash the thumbs up button as well as subscribe and hit that notification bell if you're new here to my channel. Check out my Patreon page, and if you guys are interested in more videos, check out these videos on the screen here. If you're there, I'll see you there. If not, keep up the grind and have a great day.